another day, and in order to continue our lectures on European law and Europe. I hope you are all doing well, and it's nice to see you digitally today, and I'm looking forward to be with you the next in the next 90 minutes. As in our recent lectures, please feel free to ask any questions if you like to, and I'm happy to receive your comments and questions, and I'm happy to answer them in due course. Yeah, what we are doing today, or let me before we come to our content of today, I want to shortly summarize what we learned in the course of last week. First of all, as you remember, we learned about the function of the European Court of Justice, and we took a close look at the responsibilities of the European Union. We learned for which areas of politics the European Union is responsible, and on the other side, which responsibilities remain in the purpose of the member states, the European Union. And finally, I think you remember this, we described the content of the European law. And as you know, we have to distinguish between the primary law on the one side and the so-called secondary law on the other side. And we talked about that the secondary law, of course, has to be compliant to the primary law, and that the second law especially consists of European directives, which should be implemented by the member states of the European Union in a period of time which is set out in the directive. Yeah, and today we will learn in particular about the influence of these directives on national tax law. And as you can see it on this chart today, after I will have provided you with a short overview on the influence of European law on national tax law or on national tax systems, we will especially deal with the influence of secondary law today. So you can see all the directives issued by the European Union so far with respect to or with an impact on the national taxation. And I think it is a good idea to talk about this, because maybe that gives you a better picture, or it can answer the question which requirements have to be fulfilled by a member state of the European Union in order to comply or to make the tax system of the member state compliant with the EU system. And maybe very shortly today, at the end of this day, we will also talk about the influence of the fundamental freedoms of the EC3 or of the European treaties. Especially on Thursday, we will cope with that issue, because the fundamental freedoms of the treaties have an immense impact on the national tax. So today we will focus on the directives, and on Thursday we will have a look how the influence of the fundamental freedoms of the EU treaties can be described. And as always, please be absolutely free to ask questions at any time, or use the chat room as you did in our formal. Yeah, let us start or let me start with providing you with an overview on the influence of the EU law on national tax law. I think it is a good starting point. So at first, and that is what you can see on this chart, is what we discussed formally. We always taught you that we have to distinguish the responsibilities of the European Union of the one side and the responsibilities of the member state on the other side. And one important aspect to understand is that the tax sovereignty remains largely with the competences of the member states. What does that mean? That means the member states remain or retain their competence for national tax law. So, for example, there is no European income tax or there is no European corporate tax issued by the European Union. That is still in the competence of the member state. And we will see that, of course, these systems differ. For example, we have very different tax rates in the European Union. For example, the corporate tax rates differ from state to state. And of course, we have differences regarding the income tax systems. We have differences between concerning tax exemptions or how to say what is the income of a person of a resident in the European Union. So the European Union has only limited competences, which moreover can only be exercised unanimously. This means with the consent of all member states in the Council of the European Union. If you remember, we also talked about legislation in the European Union, and we said that there is a special proceeding which applies to all directives or to all secondary law concerning tax issues. When the European Union wants to issue a directive concerning national tax law, it has to become the consent of all member states in the Council of the European Union. And as you remember, the Council of the European Union is that institution where each member state can send one minister or another appointee. And as you can see it here, if we want to issue a new directive or if we want to amend a directive concerning national tax law, we need the consent of all member states in that Council of the European Union. It is good to know that the European Union is not allowed to introduce a new tax, for example, an EU tax to finance its expenditures. We already learned how the EU is financed by contributions on the one side by the member states, and on the other side on a share of the value-added tax gained in the different member states. And you see there is always there is a little exemption. The EU has an EU tax regarding the taxation of the income of the European Union employees, but this is insignificant. The main issue or the main information you should receive is that normally the member states are responsible for their tax law, and however, it is possible for the European Union, with the consent of all member states, implement a directive, and then which has to be transformed into national tax law. Yeah, and this brings me to another point. The consequence of this legal situation is, although European tax law has an impact on the member states' tax systems, they continue to enact and apply the national laws within this frame. So if there is secondary law on the one side, and on that issue we will have a closer look on Thursday, on primary law, then the national tax systems have to be compliant to this legal framework issued by the European Union. And you can say, and I think we will learn this today, that the European law has become increasingly important for national tax law. Many standards and administrative regulations have been amended or enacted as a result of union legal influences. So we will see that a lot of directives or even the fundamental freedoms had the effect that the national tax law of the member states has to be amended or had to be amended in the past and will have to be amended in the future. Yeah, in addition, or additionally, numerous standards of national tax law of the member states are under unity. Yeah, what does that mean? We can summarize at this point that firstly, national tax law shall not violate European law, and secondly, that there are directives which have to be transformed into national tax. And on last Wednesday, we also talked about the function of the national courts in this system or in these circumstances. And you have to say that every court in the European Union has to rule whether national law or national tax law, that is our main subject as tax specialists, is in compliance with the legal framework, with the directives of the European Union. But one very important information is that only with the consent of all member states it is possible to amend or to implement a directive concerning the tax status of the member state. Yeah, some people criticize this, but as you know, it is always difficult because the tax systems in the European Union differ in very important aspects, and so not every member state is happy to get a framework to be issued on by the European. But to some extent, we have set such. Yeah, now let us have a look which directives have yet been issued by the European Union and what impact do they have on the national tax systems. And as I already told you, in the area of taxation, directives are the primary regulatory instrument. So there are mainly only directives in this regard. And we already learned in our last session that directives are binding targets for the member states. However, they require a transformation into national law and are generally not directly effective. Yeah, that is what we already learned in one of our last. Insofar as the EU directives are to regulate income taxes, that is an additional important information. Article 150 of the 15 of the Treaty on the Functioning of the European Union is the basis for the EU's authorization. The principle of unanimity applies. So a directive concerning income taxes is only possible if all member states give their consent. Yeah, and the last point or last bullet on this chart is also already said in our last session. Directives are exceptionally applicable, so without a transformation into national tax law, if they work in favor of the citizen, if it is not or incompletely transformed, and if the content of the directive is sufficiently defined. But I have to say that, or it is important to know that in most cases, the member states have transformed the directives on time, so there was no delay. However, in some cases, the national courts examine whether the directions have been transformed correctly. So that is often a question on before court, as an existing European directive correctly or transformed into national law, or are there maybe some infringements? This is our first little overview on the functioning of the secondary law on national tax law. And now we are going into detail, and we will see which directives of the European Union have already been issued by the European Union, and we will see what influence do these directives have on the national tax authorities or on the national legislation. Because, as you know, if there is a directive, and if all member states have given their consent to it, then it has to be implemented into national law. And so the purpose of today is to give you an overview which directives are there and which does that mean for the member states, and we will always have a look here, and that refers to a question you asked me in one of our last lectures, when you asked which impact does the European law has on Ukrainian law if the Ukraine enters the European. I think that is the purpose of today, to see what is there and what should be implemented in case of a membership of your nice country in the European. So let's start first of all with a very important directive of the European Union, and this is the so-called value-added tax system directive. I would like to discuss the main content of this directive, and will show you what would have to be implemented in Ukrainian law if you become a member state in the Union. So let me provide you first with some general information on that directive. This value-added tax system directive, this is the correct name of the directive, is a European directive which, on the basis of Article 113 of the Treaty on the Functioning of the European Union, prescribes a largely uniform value-added tax system in the European Union. And you can see, or it is obvious, what is the function or what is the purpose of that direction. And I have to say that this is an area of tax law which is to a very large amount harmonized in the European Union. And you can see, or it is obvious why this is the case. This is because if you want to create an internal market within the European Union, then I think it is a good, or it was a good idea that the member states are to apply legislation on the taxation of transactions that does not disturb the conditions of competition and does not impede the free movements of goods and services. Yeah, and a uniform and non-discriminating value-added tax system is of great importance for the internal market, or for the functioning of an internal market, and that was the reason why value-added tax is harmonized in the European Union to a very important extent. So the directive harmonizes national legislation on turnover taxes by prescribing a VAT system to be complied with, and the member states must adhere to a system of a so-called all-phase net value-added tax system with input tax. Now, what does that mean? That does mean, for example, if you have an entrepreneur, and an entrepreneur is obliged to invoice value-added tax and has an input tax deduction on the other hand when he purchases goods or services from another entrepreneur. That is basically the system which is governed by the value-added tax system directive. And such a system of an all-phase net VAT system should be implemented in every. This is harmonized in all member states. All member states have such kind of system. Under the system, the value-added tax is due at each stage of the value chain. But, and that is what I've already told you, entrepreneurs can deduct the value-added tax incurred on inputs as input tax vis-a-vis the taxer. So that makes sure that the product is not subject to sales tax or to value-added tax during the production process. Only when an end consumer or company that is not entitled to deduct input taxes purchases the product, then the VAT amount remain in the treasury. So you can say that this end consumer or this company which is not entitled to deduct any value-added tax, these are the persons or the legal entities who take the tax burden of the value-added tax. Now, this is a system or the main principle of all base net VAT system. After the Council which reached an agreement for amendments in December 2021, the amended directive entered into force in April 2022. And you can say, of course, there are always discussions whether the directive should be amended. And if the consent of all member states is available, then it is possible to also amend the main principles of this directive. What is also noteworthy, you can say that the value-added tax system directive does not say there has to be only one tax rate. It provides for a regular tax rate of at least 15% and a reduced tax rate of at least 5%. So if you become a member of the European Union, then your tax rate for value-added tax must be at least 15% in a regular case, and the reduced tax rate would have been at least 5%. And the directive also gives some information how tax exemptions are possible in certain areas, including foods, for example, or other goods to cover basic needs. And this is another issue which is important for the member states. The directive contains rather concrete information on these tax exemptions. So if a tax exemption is not set out in that directive, it is not possible for the national legislation to implement such a tax exemption. And of course, vice versa, if the directive says that the supply of some goods or of some services is to be exempted from value-added tax, then also the national law has to comply with this. So I can tell you that, for example, in Germany, there are, I would say, at least 5 to 6 prominent cases per year concerning the question or concerning the question whether our national or German Value-Added Tax Act complies with the exemptions for taxes in the European Value-Added Tax System Directive. So that is some thing which is not too rare, and I think, of course, it is the same in members. And one more example. I think 1 or 2 years ago, in Germany there was a discussion whether, or in Germany, they discussed that, or some people in Germany were of the opinion that it might be a good idea that value-added tax should not levite on the supply of gas. But you can see here, we are not completely free in doing or in implementing such an exemption of value-added tax, because our tax experts then say, and I think they were correct, no, that is not in line with the direction, so it is not possible to implement tax exemption for the supply of gas that would have infringed the directive and was not possible. I think it is a good example to understand how such a directive has to be transformed into national law, and the national law shall not infringe the content of the directive in an individual case. So many VAT experts told me in the past, if you want to have a tax exemption from VAT tax in Germany, we don't look primarily in our national tax code, in our VAT tax code, but we have a look in the VAT system directive in order to express our opinion how or if it is possible to exempt some transactions from value-added tax. Yeah, for example, on this chart, you can see that a big range on value-added tax rates. I already told you that the directive does not say they have to be this tax rate or this one. The directive says the tax rate should not or should be at least 15% in regular cases and at least 5% in special cases. And here you can see how the tax rates differ in the European member states. There you can see, for example, Germany in the middle of the chart, we stand with 19% at the moment. That is our regular tax rate for value-added tax. And for example, we have lower tax rate in some cases with an amount of 7%. What we could do go to 5% if we want to. You can see some last remarks on this. You can see that some of the member states of the European Union have pretty high tax rates. For example, you can see Sweden or Finland, they have 25%, 24%. And this is the background that in these countries, the value-added tax is used for financing social security issues. And so it is a little bit higher, the tax rate in this regard. So let us summarize, and maybe we can also go in a discussion if you want to. In our last lecture, you asked whether Ukrainian tax law will have to be changed when Ukraine becomes a member of the European Union. And now let me answer this as follows. In case of a membership, the European Union, your authorities or your legislation authorities would have to check whether the Ukrainian VAT system is compatible with the requirements of the VAT system directive, especially with regard to tax rates, with regard to tax exemptions, and thirdly, as I already told you, with the so-called all-phase net sales tax system, which is imposed. So you can say in the process of becoming a member of the European Union, it's a good thing if you can look through your national legislation and see what have to be amended in order to be compliant with the requirements of the European directives or the European law in general. So this is an important directive, and of course we could say a little bit more about this VAT system directive, and especially if you will be specialized in VAT tax, then you always have to do with it. So at this point of time, I just want to ask you do you have any questions on that directive, or do you have any comments on this? Maybe have a look. Have a look at the chat. That there is no question at the moment. Okay. Okay. Valeria, I think.
Yeah, I would like to ask you, what do you think about our tax rate? Maybe it's too high?
If your tax rate is too high, Valeria, could you tell me how high your tax rate is at the moment? Or maybe it is not understand. Could you please maybe tell me how high your tax rate is in Ukraine at the moment with regard to value-added tax? Valeria? Okay, maybe I can answer your question as follows. It can't be too high because the directive only says that they have to be at least 15% or 5% respectively. So in order to comply with European law, a tax rate can only be too low, but not too high. Maybe this answers your question, because it is 20. Thank you, Valerie. It is 20%. Yeah, 20% is absolutely okay. It is a little bit more than in Germany. In Germany, our regular tax rate is 19%, as I told you. And if you have a look at this chart, you are in line with a lot of states. Yeah, maybe you are a little bit higher than France at the moment. You are lower than Spain or Portugal or Italy. And yeah, I think that is, really appropriate. And of course, that would be compliant to the value-added tax system there. At least 15%. That is ruled in that directive. So any other questions, maybe? Please. Yeah, it's a pleasure. Thanks. Thanks for the question. It's always good to talk to you. And I know it is always a little bit difficult to talk or to have discussions via internet. I'm really looking forward to see you. I hope in due course in Irpin or the Ukraine, because of course it would be better to discuss vis-a-vis, and I'm really looking forward to looking into your eyes, and I think the discussion will be a little bit more easier if we will do so. So many thanks for this. I will go back to my presentation modus. And that brings me, or now we come to those directives that affect direct taxes. So, and as I already told you, these directives which concern the direct taxation or the income tax taxation or corporate taxation within the European Union, these directives are based on Article 115 of the Treaty on the Functioning of the European Union. Maybe you can have a look at that article there. It is provided that with the consent of all member states in the Council of the European Union, it is possible to implement directives with an impact on income taxation or corporate taxation. First of all, let us talk about the merger directive. Merger directives, you can see it here. This is a pretty old directive of the European Union. And I first would like to provide you with some general information on that directive. So the directive was adopted by the Council on July 1990. So you can see it is a pretty old directive of the European Union. And the purpose of this merger directive is to remove obstacles to cross-border restructurings involving companies resident in 2 or more member states. That is the main purpose of this directive. And it is good to know that this directive contains a list of types of companies that fall within the scope of the directive. And these companies must be subject to corporate income tax without any right of option and be considered resident in the European Union for tax purposes. What does that mean? Residency in the European Union means that the official seat of such a company must be within the European Union, or on the other side, the company is managed by people or by directors who are resident in the European. So this is a requirement for the directive that you have resident companies in the European Union. This directive was also amended in the past, and the main innovations were that the benefits of the merger directive are now also available for more entities, including the European company and the European cooperative society. These 2 company types are special company types issued by EU law. The European company is a corporation run by EU law, and the European cooperative society is a cooperative society run by European law. And these companies also benefit from the merger directive. And the benefits of the directive, last point, can also be enjoyed in the case of transparent entities. What are transparent entities? For example, partnerships. And I just want to give you a little example how this merger directive works, and maybe you can also check whether you already have regulation in the Ukraine which complies with such requirements. For example, if a German company was to be merged into a Ukrainian company, so the German company does not exist anymore and is merged into a Ukrainian corporation in its parent company, for example. The main function of this merger directive is that this merger does not have the effect that hidden reserves of the German company are to be taxed in Germany. So in these cross-border mergers, the directive says that the hidden reserves shall not be subject to tax. And there you can see the main purpose of that directive. It is to make it simpler for a restructuring or for a cross-border restructuring. I think we have regulation on mergers, and in Germany we have a merger code, a merger taxation code, and in this code we have implemented the directive when we say that mergers, not only in cross-border cases but also in national cases, are not subject to tax. Of course, there are some conditions have to be met to get that tax neutrality, but it is possible to avoid taxing the merger itself. So this would have to be transformed into Ukrainian law. So I'm sure you have a reorganizational tax law in the Ukraine as well. And of course, you will have some conditions to be met if a merger or a transformation of a company in another country is tax neutral. But if you when you are a member of the European Union, also cross-border transformations or cross-border mergers would have to be a subject. No taxation in your state. That would be the consequence of this merger directive in general. Now, this brings me to another directive regarding cross-border transactions, and especially to cross-border transactions resulting in a dividend payment from a subsidiary company to a parent company. And you can see this is the name of the directive. It's called Parent Subsidiary Directive, and it concerns the tax treatment of cross-border dividends within the European Union and within companies which take the role of a parent and a subsidiary. We will now learn some more details about this parent subsidiary directive. First of all, the scope of application is also a rather old directive. It's entered into force in 1990, and as I already told you, it regulates the taxation of dividend payments between associate companies within the European Union. And the main principle of that set out by that directive is that the debtor and the creditor of the payments, so the company who received the dividends on the one hand, and the company who distributes the dividends on the other hand, must be corporations domiciled in two different member states of the European Union. Yeah, and there we go again. We already talked about residence in the European Union. It is necessary that the seat or the management of these companies is seated in two member states of the Union. Yeah, and an additional requirement, a minimum shareholding of the receiving company, so of the parent company, in the amount of 10% of the capital of the company making the payments is required. So this directive does only apply in cases where we have a mother-daughter relationship or a parent-subsidiary relationship, which means that that the parent company has to have at least 10% of the shareholding of the daughter company or subsidiary. If alternatively a calculation is made on the basis of voting rights, a minimum holding period of 2 years is added. So, and participations via a permanent establishment located in the country of domicile of the subsidiary is also favored. So it is also in the scope of direct. So summarize it in short: if you have two companies, a parent company and a subsidiary, and if the parent company and the subsidiary are seated within the European Union, and thirdly, if the parent company holds shares of at least 10% in the subsidiary, then the directive is applicable and has to be or has to have consequences in the taxation of the dividends in the two member states. And this is shown here as legal consequences on this chart. In principle, in this case, if the conditions of the directive are met, multiple taxation of dividends paid across borders is to be avoided. That is the wording of the directive. The subsidiary is taxed in accordance with the regulations of the state in which it is resident, which is entitled to the full tax revenue. For example, if you have a German company which distributes dividends to another company, then on the first stage, Germany can tax the income of that company. And at the moment, it is Germany, we have a corporate tax rate of 15%. And additionally, we have that is a German specific, also nearly 15% tax burden resulted by a so-called trade tax. So a German company, if a German corporation is due to approximately, let's say it this way, 30%, and these 30% is also possible under the directive. The directive only concerns the dividends which are to be distributed to a parent. The state of the residence of the parent company is responsible for avoiding double taxation. It may apply either the exemption or the imputation method to the dividend payment. Let me demonstrate you a little example. If you are a member of the European Union, this directive would have the following impact in general. If you have a company, let's say in a corporation seated in Kiev, so it is a Ukrainian resident parent company, and if it holds a shareholding in a German subsidiary, in a German GmbH or corporation, let's say 100%, so it is easy to say that the conditions of the directive are met. Then if the German subsidiary would distribute dividends to your Ukrainian parent company, then the Ukrainian tax system would do, on the one hand, do an exemption. So you were not entitled to tax the dividend. Or another possibility were given by the directive that you tax the dividend, but then in this case you were obliged to deduct the German taxes from your taxes. But in nearly all cases in the European Union, the exemption method is applicable. So, for example, in Germany, we have implemented the requirements of this directive in an exemption method, or in implementing an exemption method. For example, if the case of in the case of investments outside Germany, dividends are exempt pursuant to a section of the German corporate income. For example, if we have a parent corporation in Germany, corporation maybe, and this corporation would receive dividends from a Ukrainian or from a Luxembourg or a Denmark subsidiary, then our law would stipulate that the dividend is to be exempted from taxation in Germany. And there is only one exemption made in this section of the German Corporate Code. The German Corporate Code says that 5% of the payments received are regarded as non-deductible operating expenses when determining taxable income. So it means, as a result, if a German company who has at least 10% shareholding of another cross-border company and receives a dividend, then 95% of the dividend is taxed. And the German corporation would only be obliged to pay taxes 15% of 5% of this dividend payment. And we also decided that we do it this way, not only in cross-border transactions, we do it the same way if we have companies or a parent subsidiary situation only within Germany. So if a German holding company receives dividends from a subsidiary company, you can say that 95% of this dividend is tax-free, and only 5% is subject to tax, corporate tax, and to trade tax. So it's subject to approximately 30%. So, and again, if you will be a member of the European Union, you would have to check whether your corporate tax system would comply with the parent subsidiary directive, and then you can implement a system maybe like in Germany, or another system which may be comfortable for your authorities. You can see where they come from. They don't want to tax the dividends over and over again. For example, if you not only have a parent subsidiary structure, but a grandmother company and a mother company, and then other companies, the dividends would always be taxed and taxed and taxed, and this should be avoided by implementing such an exemption. I think that is quite good. These 5%, which are still due, which are still to be taxed, this results from the fact that the directive also says that 5% of the dividends may be subject to tax. So these 5% result from the directive, and it is of course in this case compliant with the directive to tax these 5%. So these are some principles of the parent subsidiary directive, which has been implemented in German law for a pretty long. So maybe one question: what is your taxation of such dividends? Do you also have some rules or some tax or in your tax law regarding some tax exemptions in the case that you have a parent company receiving dividends from a subsidiary for a daughter from a daughter company? Do you still have such provisions? I would be interested if somebody maybe can explain to me how your system is at the moment in this regard. Do anybody knows about this, or I'm sure you will have some special treatments on dividends, because it's pretty common in nearly all states of the world to have some tax exemptions or some individual or some lower tax rates on dividends. It's pretty common for all. Yeah, maybe don't be shy, but if it's not possible, maybe please feel free to use the chat. I'm interested whether you also have such a system, but please feel free, absolutely. I will come back to this maybe a little bit later. So after having talked about the parent subsidiary directive and about its impact on national corporate law, we come to another point, the so-called common reporting standard. Yeah, what does that mean, this common reporting standard? It is important to know that in recent years, various measures have been introduced internationally to curb cross-border tax erosion or tax evasion. And this mainly concerns information relating to interest. And that brings me to these common reporting standards. And it is important to know that, the purpose of these standards is, as a little background information for you, that all or nearly all authorities in the world, or at least the tax authorities in Europe, should have knowledge about accounts, about interest payments of its taxpayers. Because in former days, there was a large number of people who had bank accounts. For example, Luxembourg was very popular, Switzerland was popular, Liechtenstein was very popular. And of course, it was very difficult for the tax administration of the country where such a taxpayer was resident, and thus this was the country who was able to tax this interest. It was very difficult to find out whether these taxpayers have evaded the declaration of these interest payments. And this is the reason or the background for these rulings, these common reporting standards. You can see on the next chart a little bit about the history of this common reporting standard. And I think you can honestly say that we have to say thank you to our US friends, because the US, of course, in the US, there are also a lot of taxpayers who have bank accounts in the whole world. And for the US tax administration, it was in former days not possible to assess if they have bank accounts, how high are the interest rates, and so it was possible to avoid paying taxes in the US. And this was the reason why. This was the reason why the US and other closing countries agreed to the so-called FATCA agreement, and on July 2015, the OECD also published its proposal for the automatic exchange of financial account information. And this proposal was based on the so-called multilateral agreement between competent authorities on the automatic exchange of financial account information. And in addition, in December 2014, there was a European Union directive issued with the obligation to exchange the relevant data between the tax administrations of the member states. And it is difficult, or it is important to know that the information to be provided by, we will see that is an obligation of financial institutions to provide the tax authorities with such information. This starts from 2006, but this has started from 2016 on. And you can see that by mid-2021, 104 countries had agreed to these common reporting standards. You can see here a little world card on this chart, and you can see which are the follower of these common reporting standards, and which countries were the early adopters. And as you know, if you want to become a member of the European Union, you see that all members of the European Union are early adopters of these common reporting standards. And of course, as always, it's always the same. If you want to become a member of the European Union, you are obliged to implement common reporting standards. So to enter this agreement, in which at the moment contains, I think, 110 or 115 member states. So if you are a member, if you have to implement such common reporting standards, the procedure can be described as follows. The international requirements were implemented in national law. For example, in Germany, there is an act on the automatic exchange of information on financial accounts and tax matters, and such national law is to be implemented in all states with which entered to oblige the common reporting standards, and the information required for the exchange is collected by the financial institutions. So especially the banks or the insurance companies. So everybody who holds a bank account in favor of a person is obliged to provide the national tax administration in Germany. That is the Federal Central Tax Office located in Bonn, and these financial institutions do have to provide the information to the tax. And the purpose is very clear. So the tax administration knows where are the bank accounts of the individual persons and where is interest, which is of course subject to tax. Yeah, which data have to be provided by such a financial institution? Yeah, the financial accounts that have already been opened as of December 31, 2015, they are considered to be legacy accounts, and financial accounts opened after January 2016 must be identified in accordance with the new requirement. So that is the starting point of these common reporting standards. And yes, now you can see which information has to be provided to the tax administration. This is the name, address, state of residence, the tax identification number, the date of birth, birthplace, the account number, the name and identification number of the financial institution. As I told you, this is primarily a bank or an insurance company, the account balance and interest, dividends, and other income which has entered into such a bank. And you can see this was also criticized by a lot of people, because in former days all this information was to a very high extent not available for the tax administration, because we had provisions that there is the possibility that a bank can take this information for its own. So that it's not to be offered to the administration, but in nowadays that has completely changed. So this information can also be shared by the member states. That is an important information, or important further information. So each member state may address the authority of another member state and get the information on these accounts. So this is a measure purposing to or which aims to improve the effectiveness, especially of taxing interest. In former days, it was much more difficult to find this information. So you see a lot of regulation is also issued by the European Union. These are directives which are not too easy to be implemented. It takes sometimes some years to implement every obligations issued by a directive, but you can see where they come from. It is fighting against tax abuse or tax evasion in the European Union. Yeah, what we have additionally, we also have a so-called interest and royalties directive. This directive works pretty same like the parent subsidiary directive. And this directive entered into force in 2004. And the main purpose is that this directive regulates the taxation of interest and royalty payments between associate companies within the European Union. So if there are associate companies and one company pays interest or royalties to another associated company, then these cross-border transactions, these cross-border payment of royalties or interest, or be exempt from taxation. The debtor and the creditor of the payments must be corporations resident in 2 different member states of the European Union. You can see that is the same what I told you with respect to the parent subsidiary directive. This directive differs a little bit from the parent subsidiary directive because there's a minimum sharing of 25% required in order to make this directive. Yeah, this is the main function of this directive, and if this directive applies, then the payments are to be taxed in the state which the recipient of the payments is resident, and the state in which the debtor of the payments is resident waives the levying of capital tax. No? And interest and royalty payments remain fully deductible as business expenses when determining the debtor's liability. So you can see it is always, it is the same purpose like set out in the parent subsidiary directive. Cross-border transactions with regard to loans or with regard to intangibles should not be double taxed within European Union. And this is implemented in German law, and as always, if you become a member of the European Union, these obligations would also have been implemented Ukrainian tax law as well. So let us now talking about how the European Union is combating the tax substrate to low tax countries. As you can imagine, there's always a big fear of the countries in Europe who tax at very high tax rates. What do you think? What is the country in Europe which nearly everything is taxed on the highest tax rate? It's Germany. So it is not very comfortable to be taxed in Germany. It's pretty much the same in France or in Belgium, but there are a lot of countries in the world and even in Europe which tax substantially lower than Germany. So you can see then there's always the fear of such high taxing states that maybe income or gains are to be transferred to low tax in the world. And the European Union also tried to cope with that problem about the profit shifting to low tax countries. And this brings me to the so-called anti-tax avoidance directive. It is a pretty new directive, and you can see on the following charts which is the essential content of this directive. And as I already told you, this directive rules against tax avoidance practices that directly affect the functioning of the internal market. And there is a package of legally binding anti-avoidance measures that must be applied by all member states against common forms of aggressive tax planning, so called in the directive. Yeah, Germany already has or largely complies with the minimum standards set out by this directive. Nevertheless, there was still a need for adjustment in some areas, and we adjusted or we amended some of our tax provisions which deal with such anti-tax avoidance measures. And I just wanted to give you a short overview on what measures that are, because maybe it is interesting for you, because course, the background of our lectures are always a little bit in the direction that maybe, or the question, is it comfortable for you to enter the European Union, and what impact would that directive have on Ukrainian anti-abusive regulation? So please let me just show you a little bit or some principles which are set out in that directive. First of all, we have in Article 4 of that directive the obligation that in any member state of the European Union there must be regulations limiting the deductibility of interest. Yeah, these are very complex regulations. For example, it is in cases of, let me say, excessive debt financing, the interest is not fully allowed to a deduction. That is the background of this regulation. It is also called an interest barrier. I'm not sure. Do you have an interest barrier regulation in your Ukraine system at the moment? Yeah, it is a system which says if the ratio of debt financing exceeds a certain percentage, then the interest which have to be paid by one company is not fully deductible from the income. I'm not sure. Do you have such a regulation, or do you know about such a regulation in the Ukraine? Valeria, you say no. It's not yet implemented.
I'm not sure.
Yeah. Okay.
About existing such system here.
Yeah. Okay. Well, yeah. Maybe there is no regulation existing at the moment. That could be. Yeah. Another comment, or do everyone knows about such an interest barrier in your country? They're lucky for your companies which are financed on a debt basis. It's a good thing for them because they can deduct the interest as payments, as deductibles. So it's a good thing. But in case of a membership, you would have to implement such an interest barrier set out in the Anti-Tax Avoidance Directive. Yeah, another essential content of the directive are the so-called exit taxes. Let me give you an example. If you are a resident in your country, and if you transfer assets to another country, maybe to a permanent establishment in another country, or let me stand with this case, then the hidden reserves in these assets should be taxed in your country, because these hidden reserves, so the difference between the value of these assets and the costs you had to gain these assets, these so-called hidden reserves should be taxed in that country where these hidden reserves came into effect. So, and this is also one of the purposes of this directive. This directive says if assets are to be transferred to another country, then the hidden reserves have to be taxed within the scope of 5 years. So it is possible, or it is also ruled by the European Court of Justice, that in the case that assets are transferred from one EU member to another EU member state, then the hidden reserves should be paid by the state where the asset comes from, but this state should give the taxpayer the opportunity to pay the tax rates in a 5-year ratio. So not at once, but within 5 years. Another case of that exit tax is, or typical for that exit tax is, Valeria, if you live in Ukraine and have maybe, for example, if you have a shareholding in a Ukrainian company, and you would leave to Germany or to the US or to another country, then the hidden reserve of these shareholding would also have to be subject to tax in your country, and so your country could tax these hidden reserves, and that is also set out in that anti-tax avoidance directive. So I think these regulation is understandable because the state should tax where the hidden reserves came from. I think that is a pretty logical consequence. So an exit tax is or every member state of the European Union has to implement such exit tax regulation. Yeah, and let me point out one last thing, which also has to be implemented in national tax law according to this anti-tax avoidance directive. These are so-called CFC rules, controlled foreign companies. Let me explain this by a little example. If somebody of you is has office or is permanent or is a permanent resident in your country, and he is or maybe I will put the place to Germany. If one of our persons is has his permanent establishment in Germany and holds a shareholding of a company seated in another country of the world, if this other country, if this other company is a corporation, then in this case, Germany could normally only tax, or in Germany, the person could only be taxed if it receives a dividend from that corporation. Because normally we have a separation of the taxation of the shareholder and of the corporation. And the CFC rules say, if this company in abroad, if this has passive income, this is mainly interest, dividends, and royalties, and if this company is taxed significantly lower than in the country where the shareholder has its permanent establishment, and if and to the extent there are no exemptions, then these CFC rules say that the income of the foreign corporation is also to be taxed in the country where the shareholder has its seat. Yeah, so we look through this this controlled foreign company in some cases, and you can see that the main conditions are: first condition is you have to have the majority of the shares of the foreign country corporation. Second condition is that in the country there's a low taxation. At the moment, in German, under German law, this means 25% or less. And the third condition is that the foreign company has passive income. And passive income, it is very difficult to examine whether a foreign company has so-called passive income. You can keep in mind that it's mainly dividends, royalties, and interest. And in these, or under these conditions, if these conditions are met, as I already told you, in this case, the income of this foreign company would be taxed in Germany as capital gains. So we treat that cooperation as a partnership. We look through it. We tax it like a partnership. So on these CFC rules, these are also content of the Anti-Tax Avoidance Directive of the European Union. So if you would become a member of the European Union, you would also be obliged to implement such CFC rules in Romanian tax law. And all these rules are very complicated. This is not easy stuff. Maybe some months later, we will have the chance to do a little bit international taxation, or we will be happy if we see each other again, and maybe we can talk about international taxation. So then we can go a little bit more detailed and go into some cases. Today, it's our main purpose is to see what directives are there in the European Union and what would it have mean for the implementation in the you can see these CFC rules. There are a lot of CFC rules in the world. You can see, for example, that nearly all countries in Europe have CFC rules. You can see, for example, that France, Great Britain, and and Sweden and Turkey have CFC rules concerning all income. In Germany, CFC rules are only applicable to so-called passive income. Passive income is to be defined by the national tax law, and it is defined very complicated in our tax system. You can see there are not too many states who don't have CFC rules, like, for example, Switzerland, you don't have. Yeah, and you can see the difference between European Union members and non-European members. If the Switzerland, for example, would decide to enter the European Union, they would be obliged to transfer CFC rules in their Swiss tax law. If they don't, they are free not to do. So you can see that this is important as well. Yeah, dear students, a few last thoughts for today. There are also so-called DAC 6 guidelines, which were implemented by the European Union so far. Let's do this shortly. The members of the states of the European Union are obliged to establish rules according to which certain cross-border tax arrangement must be notified to the tax authorities. So tax advisors are under European law to some extent obliged to provide the tax authorities with information on some advisory issues. These are rules which were to a large extent criticized, especially by tax advisors, but you can see the purpose of it. The tax authorities shall get information even from the tax advisors when they try to avoid taxation, or when they try to use, for example, to create income which is not taxed in any state. Yeah, and last but not least, you all heard about the global minimum taxation, which has to be implemented as well. You can see here over 130 countries, including all members of the European Union, have agreed to implement global minimum taxation rules. And these are very, very complicated rules. But in principle, they say that a globally applicable minimum tax rate for large corporations has to apply of at least 15%. So these regulations say it's at least 15, a tax rate of at least 15% should be made applicable for the income of large corporations. Now, this regulation does not affect small companies. I think at the moment it is defined as companies with returns exceeding 750 millions per year. Only these large these rulings. So, and these minimum global minimum tax is also governed by an EU directive. And I think we have today learned a lot about the directives which have yet been issued by the European Union. What we will do on Thursday is we'll have a look at the impact of European fundamental freedoms on national taxation. But I think at this point of time, for today, it is a good break. I think we are, okay, I think it is 3:30. So my last question is in every unit, are there any questions or additional remarks? I'm happy to answer whatever you wants to know about. I will look at. Okay, guys, ladies and gentlemen, dear students, let's call it a day. Thank you very much for today. I hope some of the information was a little bit interesting for you. Of course, it is a lot of stuff, a lot of technical stuff. Many thanks for your attendance. As I already told you, you are great guys, and I'm really looking forward to once get to know you a little bit better, especially to work with you on a personal basis. Thanks a lot. Have a good afternoon, and maybe see you on Thursday. Bye-bye.
Thank you so much. It was very interesting. Thank you.
Thank you very much. That's really kind. I appreciate this.
Yeah.
Okay, thank you. You have administrator rights, so you can end our meeting.
All right. Thank you very much, and thanks again. I think you organized everything.
Yes.
Thank you very much. What is your name?
My name is Alexandra.
Alexandra? Okay,
Yes.
thanks. Thanks a lot, Alexandra, and see you on Thursday.
Okay,
Have a good
bye-bye.
Bye. Thanks a lot.
Thank you. Have a nice day.
Thank you. You too. It was a pleasure to meet you. Bye-bye. So long.